How rich people use debt to get richer. This concept confuses most people because they are taught that debt is bad and that rich people must be debt-free. The reality is the opposite. Truly wealthy people use debt as a tool to multiply their wealth. The trick is borrowing at a low interest rate and investing the money at a higher return. If you can borrow money at 4% and invest it somewhere earning 8%, you pocket the 4% difference. Compound that over decades, and you have built substantial wealth using debt. Real estate is the classic example. A rich person borrows money at 4% to buy a building. They lease the building to tenants who pay rent exceeding the 4% mortgage cost. The difference between the rent and the mortgage is profit plus equity build-up as the loan is paid down. If the building appreciates in value, they win even more. They never actually paid for the building with their own money. They used debt and someone else's rent payments to acquire an appreciating asset. Most fortunes in real estate were built this way, using debt strategically. Wealthy people also use debt to avoid taxes. If you own appreciated assets, you cannot sell them and buy other assets without paying capital gains tax. But you can borrow against those assets without triggering taxes. Then use the borrowed money to buy new investments. You've diversified your portfolio without paying taxes. This strategy lets you keep control of your money longer and reinvest returns instead of losing them to taxes. Banks are willing to lend huge amounts to wealthy people because they use their existing assets as collateral. The key difference between rich people and regular people regarding debt is that rich people borrow to buy assets that generate income or appreciate, while regular people borrow to buy things that depreciate. Why isn't $1 equal to £1 or 1 yen? $1, £1, and 1 yen are all called one, but they buy completely different amounts of stuff. A single yen gets you almost nothing in Japan. A single pound gets you more than a single dollar in America. These are all just numbers on paper, so why aren't they equal? The answer comes down to history, trust, and the economic power behind each currency. Every currency started as a separate invention by a separate country. Britain created the pound. Japan created the yen. America created the dollar. Each country decided independently how to divide their money and what to call each unit. Japan chose to make the yen a small unit, so prices in Japan involve big numbers. A bottle of water costs around 150 yen. Britain chose to make the pound a larger unit, so prices involve smaller numbers. That same bottle of water costs about £1. These are just different scales for measuring the same thing, like how 1 mile and 1.6 kilometers describe the same distance. Exchange rates exist because countries trade with each other and need to convert between these different scales. The exchange rate between two currencies reflects how much stuff each currency can actually buy and how much the world trusts each country's economy. A country with a massive productive economy, low inflation, and stable government will have a currency that holds more value per unit. A country printing too much money or running its economy badly will see its currency weaken. Supply and demand for each currency on global markets sets the price every single day. The important thing to understand is that the number on the bill does not determine its value. What determines value is the economic engine backing that currency. $1 buys what it buys because of America's economy, its institutions, and global confidence in the system. 1 yen buys less per unit because Japan structured its currency with smaller units, not because Japan's economy is weaker. Comparing currencies by their face value is like comparing centimeters to inches, and concluding centimeters are smaller, therefore worse. They are just different units, measuring the same underlying reality of economic value. Why nobody can afford a home anymore. Housing has become unaffordable in most developed countries, and especially in major cities. A generation ago, a typical worker could save for a few years and buy a house. Today, many people work their entire lives without ever accumulating enough savings for a down payment. Multiple factors created this crisis. First, population and immigration have increased demand for housing faster than construction has increased supply. Second, investment firms and wealthy individuals have purchased large quantities of housing as investments, reducing the supply available to regular people trying to build primary residences. Third, regulations and zoning laws make building new housing extremely expensive and time-consuming. Interest rates have also played a major role. When mortgage rates were 2% or 3%, monthly payments were manageable. Now at 6% or higher, monthly payments have doubled or tripled even without the price of the house changing. Someone who could afford a $500,000 house at 3% interest cannot afford it at 6% interest. Meanwhile, prices have not fallen to compensate. Investment firms and existing homeowners have kept prices high because they benefit from scarcity. The builders who could expand supply face so much regulation, permitting delays and material costs that new construction homes cost more than old ones. Wealth inequality makes the problem worse. As housing prices rise, existing homeowners build enormous wealth because their house appreciates. First-time buyers cannot compete with sellers who have equity from property appreciation. In cities like San Francisco and New York, people with ordinary middle-class jobs cannot afford housing. Many have moved away entirely. The supply problem is self-reinforcing. As prices rise, fewer new builders construct housing because they cannot compete. As supply shrinks, prices rise further. The only solutions require massive increases in housing supply through deregulation and construction, or price controls that eliminate incentives to build, neither of which is politically easy to achieve. Why every country is in debt. Almost every country on Earth has debt. The United States owes over $33 trillion. Japan owes even more relative to its economy. The United Kingdom, Germany, and Canada are all deeply indebted. Most people assume this means something has gone terribly wrong, but the reality is far more interesting. National debt is not like personal debt. When you borrow money, you eventually have to pay it back in full. But a country that controls its own currency can theoretically manage debt indefinitely as long as it continues to generate tax revenue and maintains the trust of lenders. Governments borrow for specific reasons. They spend money on infrastructure, defense, healthcare, and education before they collect taxes. A country building a highway can borrow money to pay for it today, then use the economic benefits from that highway to generate higher tax revenue in the future. That borrowed money is supposed to create value. The question is not whether a country should borrow, but whether it borrows wisely, and whether the borrowed money creates more value than the interest it costs to repay. Sometimes governments borrow for wars or social programs that don't generate economic returns, and that's when debt becomes problematic. The real concern is not debt itself, but debt relative to the size of a country's economy. Japan has enormous debt, but its economy can manage it. A smaller country with the same debt amount would be in serious trouble. Investors look at the debt to gross domestic product ratio to assess risk. If debt grows faster than the economy, eventually lenders will lose confidence and demand higher interest rates. If interest rates spike too high, the cost of borrowing becomes unsustainable. What matters most is whether a country is moving in the right direction. If debt is growing but the economy is growing faster, the situation is improving. If debt is growing while the economy shrinks, problems are approaching fast. Why can't we just print more money? The desire to solve problems by printing money is deeply human. When a government needs more money for schools or hospitals, why not just create it? The answer involves a concept economists call the money supply and its relationship to the actual goods and services available in an economy. If you instantly doubled the money in circulation, but did not double the amount of food, housing, cars, or services, prices would simply double to compensate. Everyone would have twice as much money, but could buy the same amount of stuff. Printing money is essentially inflation when it exceeds the growth of real economic output. Imagine you and your friends play poker and suddenly the dealer gives everyone twice as many chips while the pot of money stays the same. Everyone's chips are worth half of what they were before. The chips did not become more valuable. They just multiplied without any corresponding increase in actual value. This is what happens to currency. If money supply grows too fast, each dollar becomes less valuable because there are too many dollars chasing too few goods. Governments and central banks understand this, which is why they do not simply print unlimited money. They carefully manage how much money enters the economy, trying to balance the need for growth with the risk of inflation. If they print too little, growth stalls and people suffer unemployment. If they print too much, inflation erodes everyone's savings and makes planning impossible. During massive crises like wars or pandemics, governments do print substantial amounts of money because the alternative of economic collapse is worse. But they understand the cost will be paid through inflation. The real limit on printing money is that eventually people stop believing in the currency. If a government prints money irresponsibly for years, people abandon the currency for something else or demand higher prices for everything. What if inflation goes negative? Negative inflation is called deflation, and it sounds wonderful until you understand the economics. When prices fall and your money becomes worth more every day, shouldn't that be great? The problem is that deflation creates psychological effects and economic incentives that lead to disaster. If prices are falling, people delay purchases. Why buy a car today for $30,000 when you expect to pay $28,000 next month? Businesses see demand disappearing and cut production. This causes unemployment to rise. Unemployed people buy even less. Prices fall further. This creates a deflationary spiral that is far harder to escape than inflation. Japan experienced a version of this in the 1990s and 2000s. Growth slowed, prices fell or stayed flat, and consumers kept delaying purchases expecting better deals. The economy stagnated for decades despite enormous stimulus efforts by the government and central bank. Savers benefited because their money was worth more, but workers and entrepreneurs suffered because businesses refused to invest or hire. Central banks hate deflation because their main tool is printing money and lowering interest rates. When deflation takes hold, these traditional tools lose power. Deflation also makes debt worse. If you borrow $1 million and prices fall by 10%, that debt becomes worth more in real terms. You owe the same amount of money, but it's harder to repay because your income and business revenue probably fell too. This discourages borrowing and investment, slowing economic growth even further. In an inflationary environment, borrowers benefit from falling money values. In a deflationary environment, savers benefit, but borrowers and workers suffer tremendously. The fear of deflation is why central banks target modest inflation of around 2%. They consider this the sweet spot between the disasters of high inflation and the stagnation of deflation. The Diderot effect and why buying one thing makes you buy more. Philosophers have noticed something strange. When you buy one nice new item, it makes your other possessions look shabby by comparison. So you buy something to match it. Then something else looks bad. Then something else. One purchase triggers a cascade of purchases that you never intended. This is called the Diderot effect, named after the French philosopher who first documented it. It's a psychological phenomenon, but it's also perfectly engineered by retailers. You buy one nice pair of shoes, they don't match your wardrobe, so you buy a new outfit to go with them. That new outfit doesn't match your old furniture, so you start replacing furniture. Before you know it, you've redecorated your entire bedroom. What started as one pair of shoes costs you thousands. The effect is stronger when the item is more visible or more expensive. A $10 coffee mug might not trigger it. A $5,000 couch definitely will. Luxury brands understand this perfectly. They know that one designer purchase will make you want to upgrade everything else. They call this aspirational shopping. It's part of their marketing strategy. They'll advertise one piece knowing it will make you want to buy 5 more. The way to avoid this is to buy replacements, not additions. If your shoes don't match anything, that's fine. Keep them in the closet. Don't upgrade your entire wardrobe. The Diderot effect relies on the assumption that your possessions should create a cohesive whole. That's a trap. You don't need everything to match. You don't need to update your life every time you buy something new. Embrace the mismatch. Difference between trading and investing. Most people confuse trading and investing, but they are fundamentally different activities requiring different skills and mindsets. Trading is buying and selling securities, currencies, or commodities over short time periods, sometimes minutes or hours, with the goal of profiting from price movements. Investing is buying assets with the expectation of holding them for years or decades to accumulate wealth from dividends, interest, or long-term price appreciation. These are not just different time horizons, they involve completely different approaches to making money. Traders try to profit from short-term volatility. They study price charts, follow news that might move markets today, and exit positions quickly. A successful trader might make money on 50% of their trades, but keep their profits larger than their losses. This requires discipline, rapid decision-making, and constant attention to markets. Traders are often wrong on individual trades, but right on average. Investing is almost the opposite. An investor buys assets they believe are undervalued based on fundamental analysis of the company or asset. They hold through ups and downs, reinvest dividends, and let compound growth work over decades. Investors hope to be right on the direction, but do not care about short-term price fluctuations. The statistics strongly favor investing over trading. Most professional traders fail to beat the market after accounting for fees and taxes. Most individual traders lose money. Yet studies show that ordinary people who simply buy and hold a diversified portfolio of stocks and bonds consistently beat professional traders because they avoid transaction costs and emotional decisions. A trader might trade 100 times a year and pay fees on each trade. An investor might trade once a year or less. Time is also a factor in success. Traders can make money only while actively trading. Investors can build wealth while sleeping because their money is working through compound interest. Why free things are actually more expensive. Whenever you see the word free, your brain should trigger a warning. Free always has a catch. Free apps, free shipping, free trials, free samples. All of them are designed to extract value from you in ways that feel invisible. Free is often the most expensive option available. Free apps are the clearest example. You're not paying money, so you think it's free, but you're paying with your data. The app collects information about you, your location, your contacts, your behavior. That data is sold to advertisers and marketers. The value of your data often exceeds what you would have paid for the app. You paid more, just not with money. You paid with privacy. Free trials work similarly. You get 1 month free, no credit card required. Actually, credit card is required. They process a $0 charge. Then month 2 hits, and you forget to cancel. Suddenly you're charged $29.99. By the time you notice, they've already charged you multiple months. The free trial was bait. It was never about giving you something free. Free shipping looks like a gift from the store, but someone is paying for that shipping. Either the store is, which means they've built the cost into the product prices, or you are through subscription fees or hidden markups. There's no such thing as truly free. Every incentive has a cost. The best purchases are the ones where you've agreed to pay directly for the value you receive, not the ones where something feels free. Why some countries want their currency to be weak? Every country says it wants a strong currency, but many secretly prefer a weak one because weak currencies have genuine economic benefits for certain groups, even if they hurt regular citizens. Understanding this contradiction explains a lot about global trade conflicts and why wages stay flat. A weak currency makes your exports cheaper to foreign buyers. If your country makes cars and your currency weakens 30%, foreign buyers suddenly see cars that are 30% cheaper. They buy way more. Companies ramp up production and hire more workers. Your unemployment falls and factories run overtime. Meanwhile, workers see their wages in the local currency stay the same while import prices rise. They can afford less stuff, but at least they have jobs. Manufacturing countries love weak currencies because they are exporters. China, Vietnam, and other factory nations actively keep their currencies weak. They prevent their currency from rising even when their exports explode. This keeps manufacturing jobs at home and exports competitive. Rich countries export financial services and technology, but also import manufactured goods. So the currency weakness of poor countries keeps those imports cheap for wealthy consumers. A weak currency worsens inequality in the short term because import prices spike. Poor people paying in the weak currency suffer most. Wealthy people with offshore assets in strong currencies barely notice. But politically, weak currencies mean manufacturing jobs stay home rather than moving overseas, building support from workers in those industries. The weak currency strategy eventually fails because it depends on other countries tolerating your cheap exports indefinitely. Rich countries eventually retaliate with trade barriers or restrictions. You cannot have the entire world running on weak currencies simultaneously because someone has to run the strong currency. The strategy also means slower overall growth and lower living standards. But in the short term, it delivers what politicians promise to voters. What is Bitcoin? Bitcoin is digital money created by an unknown person or persons in 2008 using a technology called blockchain. Unlike traditional currencies controlled by governments and central banks, Bitcoin is controlled by mathematics and computer networks. Nobody can create fake Bitcoin because of the way the system is designed. Miners solve complex mathematical puzzles to verify transactions and create new Bitcoin. This process makes forgery practically impossible without control of most of the network. Each Bitcoin transaction is recorded permanently and publicly, making it transparent and preventing double spending where someone spends the same Bitcoin twice. The most important feature of Bitcoin is that it is limited in supply. Only 21 million Bitcoin will ever exist. This scarcity is designed into the code itself. Governments and central banks can print unlimited money, but nobody can print unlimited Bitcoin. This is why some people see Bitcoin as a protection against inflation and government currency debasement. The supply schedule was set in the code from the beginning, and it cannot be changed without agreement from the network participants. Bitcoin works through a network of computers that all maintain the same record of every transaction. If someone tries to cheat or lie about their Bitcoin balance, the other computers in the network reject that transaction. This makes the system trustless in theory, meaning you don't need to trust a bank or government, only the mathematics underlying the network. However, Bitcoin is extremely volatile. The price can swing wildly based on sentiment, regulation news, and market cycles. This volatility makes it a poor store of value compared to government currencies, though it appeals to people who distrust traditional financial systems. Bitcoin cannot be printed, seized by governments easily, or frozen by banks. For this reason, it appeals to people who want financial independence and protection from government control or inflation. Who really pays the tariffs? When a government imposes a tariff on imported goods, most people assume the foreign company selling the goods pays the tax. In reality, tariffs are paid by the domestic consumer. Here's how it works. A company in China manufactures a product and ships it to the United States. The tariff is assessed not at the Chinese factory, but when the product enters the United States. The Chinese exporter or their American importer must pay the tariff to the government. But this cost doesn't stay with them. It gets passed along through the supply chain directly to consumers in the form of higher prices. When the United States imposed tariffs on steel, the companies that use steel in manufacturing had to pay more for their raw materials. Did they absorb these costs? Rarely. Most passed the increase directly to consumers. Cars became more expensive. Appliances became more expensive. Construction projects cost more. A tariff ostensibly designed to protect American workers and manufacturers actually raises prices on everything Americans buy. This hits lower-income households hardest because they spend a larger percentage of their income on basic goods. Wealthy households can absorb higher prices more easily. There is one group that might benefit from tariffs. Domestic producers of those goods can raise their prices closer to the imported price without losing customers. If imported steel is now expensive due to tariffs, American steel companies can charge more without being undercut. So tariffs work as intended from a protectionist view, but the cost is paid by consumers through higher prices. Politicians often ignore this reality because it's not obvious to voters. The economic evidence consistently shows that tariffs protect specific industries, while making most consumers worse off overall. How money laundering works. Money laundering is the process of making illegally obtained money appear to come from legitimate sources. The term comes from the idea that criminals need to clean their dirty money, though the real process is far more sophisticated than running it through a washing machine. Drug traffickers, corrupt officials, and criminals need to move their ill-gotten gains into the financial system without drawing attention from authorities who track large cash deposits and suspicious transactions. The challenge is that banks report large cash deposits and unusual patterns to government agencies looking for criminal activity. The classic money laundering technique involves 3 steps. The first step is placement, where illegal cash enters the financial system. A criminal might deposit cash through restaurants, casinos, or other businesses that handle large amounts of physical currency. The restaurant reports the deposit as restaurant revenue, mixing criminal cash with legitimate business income. The second step is layering, where the money moves through multiple transactions, accounts, and countries to make its source untraceable. Money moves from the restaurant to a bank, then to a foreign bank, then to a shell company, then to investments. The third step is integration, where the criminal reintroduces the laundered money into the economy as if it came from legitimate sources. They might withdraw it as loans from their own companies, claim it as inheritance, or receive it as investment returns. Now the money appears clean, and the criminal can spend it openly without suspicion. Modern money laundering has become incredibly sophisticated, using cryptocurrency, shell corporations in tax havens, trade-based laundering, and complex derivative transactions designed to obscure origins. Governments fight money laundering by requiring banks to report suspicious transactions, implementing international standards for financial transparency, and prosecuting those caught moving illegal money through the system. Why we spend more. When we use credit cards. The moment you pull out a plastic card instead of handing over cash, something strange happens in your brain. Studies show that people spend between 20 and 30% more when using credit cards compared to cash. This isn't random. When you physically hand over money, you feel the loss immediately. Your brain registers it. But with a card, there's psychological distance between you and the cost. You don't see the money leave your account right then and there. The problem gets worse because credit cards make spending feel abstract. Instead of thinking, I'm paying $99 for this, your brain thinks, I'm charging $99. Those words create different mental frameworks. Charging feels temporary. Paying feels permanent. This is why restaurants, clothing stores, and every retailer that accepts cards loves them. They know you'll spend more. The transaction feels less real, less painful, even though you'll be paying interest later. Companies have weaponized this psychological quirk. Payment systems are designed to be frictionless. One click on your phone, your fingerprint. No confirmation, no pause, no moment to reconsider. The easier the purchase becomes, the less cognitive effort you expend, and the more money you spend. This is intentional design. Every year, technology removes another layer of friction between impulse and action. The credit card companies benefit three ways. You spend more total, so you carry higher balances. Then they charge you interest on those balances. And they take a cut from the merchants too. So they're winning whether you pay on time or not. Understanding this psychological trick is the first step to fighting it. Some people have actually gone back to cash specifically to regain that pain of payment. It sounds harsh, but it works. The late fee business model. Late fees have become a money printing machine for banks, credit card companies, and any business that wants to charge you for being human. A single late payment can trigger fees between $25 and $35. In some cases, even higher. But here's what's wild. That fee is often much larger than the actual cost of the company's time to process your late payment. Late fees aren't really about compensation. They're about punishment and profit. Companies know that people miss due dates. They don't try very hard to prevent this. In fact, some of the largest payment processors have been accused of deliberately making it hard to find payment due dates or automatically advancing the dates to create more failures. They engineer the failures. The late fees are the feature, not a bug. The system is rigged in other ways too. A payment that arrives 1 day late costs you $30. 2 days late also costs you $30. So the company has no incentive to accept a slightly late payment versus a day past due payment. They get the same fee either way. And if your payment is late, they often raise your interest rate as well. One mistake costs you in multiple ways. The worst part is that this mostly affects people who can least afford it. Someone living paycheck to paycheck is more likely to miss a due date. Someone with emergency savings is less likely. So the system takes more money from people who have less money. It's a regressive tax on struggling people. If you want to fight this, set up automatic payments, or set reminders a few days early. Make it impossible to miss the deadline. Why luxury brands burn their unsold clothes? Every year, luxury fashion houses destroy millions of dollars worth of perfectly good clothing. Not because the clothes are damaged or defective, because their last season. Burberry, Louis Vuitton, Dior, and others have admitted to burning unsold inventory. They set it on fire. This happens more than you'd think. The practice is so standard that luxury companies don't even hide it anymore. The reason is simple but brutal. Luxury is built on scarcity. If everyone could buy a designer coat at the end of the season for half price, it wouldn't feel luxurious anymore. The value comes from exclusivity and cost. So brands destroy excess inventory instead of discounting it. They would rather turn perfect coats to ash than let people buy them cheaply. A discounted Dior bag is a contradiction. It breaks the entire luxury business model. This also protects profit margins. If you're selling a coat for $4,000, a 60% discount means you're leaving money on the table. The company would rather destroy the coat than sell it for $1,600. From a pure profit perspective, fire is cheaper than discount. It's a calculated decision. They run the math and decide that destruction is better for the brand and the bottom line. Some brands have shifted tactics after public outcry. Instead of burning clothes, they donate them or shred them quietly. But the fundamental truth remains. Luxury companies will never let their products become affordable. They maintain artificial scarcity at any cost, including burning perfectly wearable clothes. If you've ever felt guilty buying fast fashion, remember that the luxury industry is even more wasteful. They're just worse at admitting it. How girl math and boy math actually work. Girl math and boy math are two completely different systems of rationalizing spending. Girl math uses creative accounting to justify purchases that might not make logical sense. Boy math mostly just ignores the spending and pretends it didn't happen. Neither system is honest, but they're both deeply human. Girl math works like this. If an outfit is on sale for 50% off, girl math says you're saving money, so buying 5 outfits actually saves you money. That's wrong, but it feels right. A coffee that costs $5 is free if you use a gift card. The money was already spent when you bought the gift card, but gift card money feels like it exists outside the normal budget. Girl math creates these mental categories where some spending is rationalized as saving or using found money. Boy math operates differently. It says, I don't know how much I spent, and I don't want to know. The theory is that if you don't calculate it, it doesn't count. Many men genuinely don't track spending. They don't look at credit card statements. They assume their partner is handling it. Boy math is less about rationalizing purchases and more about denying they happened at all. Both systems are defense mechanisms against guilt. The truth is that both approaches are just ways to avoid responsibility for spending. Neither actually makes financial sense. Real financial health requires looking at spending directly and accepting it. Not through girl math filters or boy math denial, but just accepting the cost. Once you stop rationalizing or denying, you can actually make intentional spending decisions. That's harder, but infinitely more effective than either math system. Why winning the lottery? usually leads to bankruptcy. Americans spend more than $90 billion annually on lottery tickets. Most people lose, but for the few who win, the disaster is often worse than having never won at all. Around 70% of major lottery winners declare bankruptcy within 7 years. That's not a coincidence. It's a predictable outcome of how sudden wealth interacts with human psychology. The problem starts immediately. Suddenly you have more money than you've ever had. You don't have a plan for it. You don't have discipline around it. You've never managed that kind of wealth before. So you spend it. Friends and family emerge with requests. You feel like you should help. Relatives who never called suddenly ask for loans. You've been broke your whole life, so the idea that this money should last decades doesn't feel intuitive. It just feels like a lot. Lottery winners also face tax nightmares and investment failures. They often hire financial advisors who are actually con artists. They make terrible investment decisions. They buy businesses they don't understand. They co-sign loans for people who default. Meanwhile, they're suddenly famous in their community. People know they have money. Criminals target them. Divorce attorneys circle them. The real issue is that money is a skill. You can't buy financial wisdom. Winning the lottery is random. Becoming wealthy is a process that teaches you discipline and restraint. Most lottery winners never learn those lessons. They simply got lucky and lack the psychological tools to handle it. That's why suddenly rich people often end up broke again. How planned obsolescence keeps you buying. Manufacturers have a secret incentive. They want your stuff to break. Not immediately, but before it gets too old. Before you run out of reasons to upgrade. This is called planned obsolescence, and it's one of the most effective wealth extraction strategies ever invented. Companies make products with intentionally short lifespans. Phone batteries degrade after 2 years. Appliances fail after 5 years. Clothes fall apart after 20 washes. This isn't an accident. Engineers could make things last forever, but they don't. Because if your phone lasted 15 years, you'd only buy one phone every 15 years, instead of buying one every 2 years. That cuts Apple's revenue in half. So they design phones to slow down after a couple of years. You don't need a new phone because your old one broke. You need a new phone because your old one got slow. Manufacturers also make it impossible to repair things yourself. Your jeans rip. You can't patch them because the fabric is slightly different now. Your headphones break. The manufacturer wants you to buy new ones, not repair the old ones. They design products to be disposable because disposable products are profitable products. The environmental cost is staggering. Landfills fill with products that could still work. Resources are wasted manufacturing replacements for things that weren't actually broken. But from a pure profit perspective, planned obsolescence is genius. It transforms durable goods into recurring revenue. It's one of the most effective ways to keep people buying. Why diamonds are technically worthless. Diamonds have been sold to us as symbols of eternal love and markers of wealth for about 100 years. But the truth is far less romantic. Diamonds are not rare. They are not scarce. They are not even particularly valuable. You think they are because of one of history's most successful marketing campaigns. In 1938, De Beers Diamond Company, which controlled roughly 90% of global supply, hired an advertising agency to solve a problem. Diamond sales had crashed during the Great Depression, and they needed to make diamonds desirable again. The campaign that followed created the idea that diamonds equal love. They placed diamonds in movies, sent them to celebrities, and ran ads showing diamonds as essential for engagements. The famous slogan about diamonds lasting forever became synonymous with love and commitment. Before this campaign, diamonds were not engagement ring standards. Most people used other gems or no ring at all. De Beers created demand from literally nothing. It was so successful that we now assume diamonds are precious when they are just rocks that are not actually rare. Diamonds are not rare because huge supplies exist on Earth. New mining technology has flooded markets over decades. They are kept artificially scarce by the industry controlling supply. If major companies released all stockpiled diamonds, prices would collapse. Diamond prices stayed stable not because they are naturally scarce, but because supply is tightly controlled. Lab-grown diamonds that are physically and chemically identical are now available, and the traditional industry is panicking. They spend millions convincing you lab-grown versions are somehow lesser. The proof that diamonds have no inherent value is obvious. Try selling a diamond back to a jewelry store. They will offer 30 to 50% of what you paid, maybe less. If diamonds were truly valuable, they would hold value like gold or silver. Instead, they depreciate the moment you leave the store. You cannot resell diamonds easily. You cannot use them practically. They are pretty rocks that cost money because marketing decided they should nearly a century ago. The cost of being poor and why it is expensive to have no money. Poor people face a financial version of Murphy's Law. Everything that can go wrong will cost them more. It costs more money to be poor than to be rich. This is called the poverty premium, and it's baked into the system. Start with housing. Poor people are more likely to rent than own. Rent is expensive relative to mortgages, but they can't buy a house because they don't have a down payment, so they stay renting forever, building no equity. Meanwhile, richer people buy homes, build equity, and eventually sell those homes for a profit. The same monthly payment creates wealth for the rich and poverty for the poor. Insurance is the same. Poor people have worse credit, so they get charged higher insurance rates. They pay more for car insurance and health insurance than rich people. A poor person with a bad credit score pays 20% interest on a car loan. A rich person with excellent credit pays 3%. The poor person pays hundreds of dollars more per month for the same car. But the real cost of being poor is time. Poor people work multiple jobs. They're tired. They make worse decisions when they're tired. They eat fast food because they don't have time to cook. They miss medical appointments. They can't access preventative care, so they end up in emergency rooms with expensive treatments. Being poor is exhausting and expensive. Breaking out of it requires money, time, and luck. You need all three. Why we value things more. Just because we own them. Once you own something, you value it more than you did before. This is called the endowment effect. A mug you own is worth more to you than the exact same mug you see in a store. People reject trades that seem fair on paper because they've developed emotional attachment to what they already own. Psychologists have tested this extensively. Give someone a mug and ask what they'd take to sell it. They'll ask for much more than they would have paid to buy that same mug. The ownership changed the value. This effect is particularly strong when you've owned something for a long time, or when you've put effort into it. A sweater you knitted yourself is worth more to you than a sweater you bought. The endowment effect has real financial consequences. People hold on to losing investments too long because they've become emotionally attached. They renovate houses extensively and then are shocked when the house doesn't sell for what they think it's worth. They overpay for their own used car when trading it in because they've inflated its value in their mind. The effect shows us something important about ourselves. Value isn't objective. It's emotional. We're not purely rational creatures making logical decisions about worth. We're animals that develop attachments and irrational preferences. Understanding this about yourself is the first step to making better decisions. When you're tempted to hold something because you own it, pause and ask if that's actually a good financial decision. Ownership bias is powerful, but it's not truth. Who owns the Federal Reserve? The Federal Reserve is technically owned by the United States government, but the actual story is far more complicated. When the Fed was created in 1913, Congress designed it as a hybrid between a private and public institution. The 12 regional Federal Reserve banks are owned by commercial banks in their districts, which sounds sketchy but matters less than you think. The real power sits with the Board of Governors, appointed by the President and confirmed by the Senate, making it essentially a government agency. Here is what actually matters. The Federal Reserve does not answer to Wall Street bankers the way conspiracy theorists claim. Yes, regional banks are owned by commercial banks, but those banks cannot control the Fed or set monetary policy. The chair and governors set policy and answer to Congress and the American people. They manage interest rates, control inflation, and aim for low unemployment. If the Fed served private bankers, it would not have raised interest rates aggressively in 2023, when that made big banks very uncomfortable. The Fed must return all profits to the Treasury after operating expenses. In 2023, the Fed returned $42 billion to the government from interest on securities. That money goes straight to taxpayers. A truly private entity would keep that money. The Federal Reserve is ultimately a government tool that exists to serve the public interest, even if the ownership structure is confusing. The real issue with the Fed is not secret ownership, but accountability and transparency. They make huge decisions affecting your mortgage, job prospects, and savings, but the chair only testifies in Congress a few times yearly. The boring government explanation is actually the truth here. The Fed matters not because shadowy bankers secretly run it, but because of what it actually does with public trust and public money. How free trading apps make money from you. Free trading apps like Robinhood did not invent free stock trading, but they perfected making money off your trades without you knowing it. When you buy 100 shares of Apple on Robinhood, you pay 0 commission, which seems amazing until you realize Robinhood is making money somewhere. The answer is payment for order flow, how most free brokers survive. When you place a trade, Robinhood sells the right to execute that trade to market makers like Citadel Securities or Virtue Financial. Those firms pay Robinhood for your order and make money by buying your shares slightly cheaper than they sell them to others. This creates a conflict of interest that deserved more attention. Market makers benefit when retail traders make bad decisions because they profit off the bid-ask spread. A free trading app has less incentive to discourage bad trading and more incentive to encourage trading often. Robinhood made this worse by adding fractional shares, notifications about stock movements, and confetti animations when you trade. These features encourage more trading, which generates more payment for order flow, which makes Robinhood more money. You are not the customer. You are the product being sold to market makers. Free trading apps also make money through margin lending and options trading. If you use margin, meaning borrowed money, you pay interest to Robinhood. If you trade options, Robinhood makes money from order flow. Options are especially lucrative because they have higher transaction frequency and bigger spreads. Free trading apps want you trading options constantly because each trade generates more payment for order flow than stock trades. Payment for order flow is legal but not obvious. When you think you are trading for free, you are actually paying hidden costs in worse prices than elsewhere. You might buy Apple at $190.40 instead of $190.39. That 1 penny difference seems tiny, but across millions of retail trades, It adds up to billions, flowing from retail traders to market makers. Free trading apps are not evil, but they have financial incentives that do not always align with your success. Why gas prices go up fast but come down slow? If you notice gas prices spike overnight but take weeks to fall back down, you are not paranoid. This is real and happens for frustrating reasons, mostly about how oil markets and gas stations operate. When crude oil prices jump, gas stations raise prices immediately because they must replace inventory at the new price. If they did not raise prices right away, they would be selling gas at a loss. A gas station buys a tanker truck at the higher wholesale price and has no choice but to pass that cost to customers immediately. The reason prices come down slowly is less conspiracy and more about gas station competition. Most gas stations operate on profit margins between 2 and 3%, which is incredibly thin. When crude oil prices fall, the first station to drop prices loses money on expensive inventory it already bought. Stations are willing to wait because there is no urgency. Customers will not cancel road trips because gas costs 3 cents more today than tomorrow. Without urgency to compete, prices stick around longer than they should. Geography and inventory also matter significantly. A remote gas station might not get new inventory for days or weeks. If prices fell yesterday in New York, that station might not know or care because they already bought inventory sitting in their tank. Selling gas at a loss is worse than waiting for another shipment. In cities with dense competition, prices fall faster because stations actually compete on price. In areas with fewer stations, you see price differences of 30 or 40 cents between competitors. There is also inventory management working against you. When wholesale prices drop, smart station owners who bought expensive inventory do not immediately lower prices because they want to recoup costs. They wait for expensive shipments to get pumped out before restocking at the new lower price. This is not corruption, it is basic business math. The whole system gets your money instantly when prices rise, but gives you no urgency when prices fall. It is annoying, but how markets work when one side has all urgency and the other side does not. How a 1% fee can steal half your retirement. This one absolutely blows people away, and the math is so wild you might think I am exaggerating. I am not. A seemingly tiny 1% annual fee can cost you roughly half your retirement wealth over 40 years. This is not magic or conspiracy. It is just compounding working against you instead of for you. Let us say you start with $100,000 at age 25 and retire at 65. You get average annual 7% returns. After 40 years, you would have about $1,497,000 without fees. Now imagine you pay 1% annually to a financial advisor or managed fund. Your net return is now 6% instead of 7%. That 1% compounds every year for 40 years. After that same period, you would have only about $1,028,000. You lost roughly $469,000 to 1%. The fee ate almost a third of what your money would have become. 1% is never just 1% when compounding is involved. The pain gets worse the longer you invest. With a 30-year horizon, a 1% fee costs about a quarter of your wealth. With a 50-year horizon, it costs close to half. If you started at age 20 and retired at 70, a 1% fee would devastate your final balance. This is why index funds charging 0.03% instead of 1% are not boring. They are wealth-preserving choices. The difference over 40 years is hundreds of thousands of dollars. That is your future self begging you to pick the cheaper fund. This math works because of exponential growth. Every year you do not pay the fee, your money grows by 7%, and that larger amount grows 7% again next year. Paying 1% yearly removes a slice from your pocket into Wall Street pockets. Over decades, that removal compounds into massive holes in wealth. This is why high-fee advisors are increasingly hard to justify unless doing something extraordinary. For most people, low-cost index funds do more for retirement than any high-fee advisor ever could. The truth behind unlimited data and subscriptions. Unlimited data plans sound amazing until you realize unlimited does not mean unlimited the way your brain interprets it. Cell phone companies started selling unlimited data in the mid-2000s and have been finding creative ways to limit it ever since. The most common trick is throttling, which means the company slows down data speeds dramatically after you hit a threshold. You might have unlimited data, but after using a certain amount, speeds drop so far that streaming becomes impossible. That is technically unlimited, but practically unusable. Some carriers go further with deprioritization. During network congestion, unlimited customers who use lots of data get pushed to the back of the line. You might have a signal bar, but your video will not buffer because your phone is deprioritized compared to someone who used less data. This is buried in terms of service nobody reads. Another trick involves plans that are actually limited to set monthly amounts. Exceeding that amount means deprioritization or throttling without breaking terms. Subscription services pull the same moves with streaming video and music. Netflix offers unlimited streaming, but cracked down on password sharing and started charging for extra members. YouTube offers unlimited video watching, but with ads interrupting constantly. The unlimited part is real, but the useful part is limited. Spotify offers unlimited listening, but wants to restrict offline downloads. These companies use unlimited to attract customers, then use fine print to actually limit what you can do. The psychology behind unlimited is powerful. Your brain hears unlimited and thinks you will never hit a wall. Walls are everywhere, just hidden in throttling speeds, deprioritization, or congestion clauses. Companies benefit from customers feeling unlimited access while actually having limited access, because those customers feel satisfied while paying for more than they use. The word unlimited is marketing genius closing sales, while footnotes close your speeds down. How companies use shrinkflation to hide price hikes. Shrinkflation is one of the sneakiest ways companies raise prices without technically raising prices, and it has gotten absolutely wild. The idea is simple. Instead of raising the price from $4 to $4.50, a company shrinks the product from 16 ounces to 14 ounces and keeps the price at $4. You are paying more per ounce, but you do not see a price increase at checkout. You just see your usual price and assume it is the same deal it always was. It is not. Companies started doing this aggressively during the inflation spike of 2022 and 2023. Ice cream containers went from half gallons to 1.5 quarts. Cereal boxes got smaller, but stayed at the same shelf price. Chocolate bars shrunk. Yogurt cups shrank. Paper towel rolls got thinner. The list is staggering. Some companies reduced packages twice in 1 year. A company might go from 16 ounces to 14 ounces in March, then from 14 ounces to 13 ounces in August. If they raise prices twice, customers would notice and complain. If they shrink twice, most people never notice. The math is brutal when examined closely. Peanut butter costing $4 for 12 ounces is more expensive per ounce than peanut butter costing $4.50 for 16 ounces. The smaller container has higher unit price, but your brain sees the same $4 price and assumes it is the same value. Shrinkflation exploits this psychological blind spot. It also exploits the fact that most people do not calculate price per ounce when shopping. The ones who do notice shrinkflation first. The most infuriating part is companies do this while claiming they are not raising prices. Their marketing says the price is the same, but what changed is you get less product. It is a price increase dressed as a non-increase. Some consumers have started fighting back by tracking shrinkflation and calling companies out on social media. Shrinkflation works because companies get away with it, and they will keep getting away with it as long as consumers do not notice. The moment you start comparing unit prices, you become immune to this trick. What happens to your money when a bank fails? When a bank fails, your first instinct is probably panic, which is completely understandable. But there is a safety net called the Federal Deposit Insurance Corporation that guarantees your deposits up to $250,000 per depositor per bank. This guarantee is real, and the Federal Deposit Insurance Corporation has never failed to protect insured deposits in its history. Understanding how the process works will make you way less nervous about bank failures. When a healthy bank buys a failing bank, they also acquire all deposits. If you have $30,000 at First Bank and Second Bank buys First Bank, your $30,000 is now at Second Bank. You do not lose it. Your account just moves. You might not even notice the transition because your account number and access usually stay the same or transfer seamlessly. This is the best case for depositors because your money moves to a bank that actually has capital and is managed competently. This has happened hundreds of times in American banking history. If no bank wants to buy the failing institution, then the Federal Deposit Insurance Corporation actually pays your deposits directly, though not always instantly. They typically process payments within a few business days, sometimes faster. If you have $200,000 and the maximum insurance is $250,000, you get all $200,000. If you have $300,000, you get $250,000 and lose $50,000. The insurance covers checking accounts, savings accounts, money market accounts, and certificates of deposit. The real issue with bank failures is that your money can be frozen for a few days while everything gets sorted out. You cannot access your account during this period. Beyond that, your money is actually protected as long as it falls within the insurance limit. Another important detail is that coverage is per depositor per bank, not per account. If you have 5 checking accounts at the same bank, they all count toward your $250,000 limit combined. Why stores are designed like mazes? Ever notice that grocery stores seem designed to make shopping take forever, and the stuff you actually want is always in the back corner farthest from entrance? That is not an accident. It is science and completely intentional. Stores are deliberately designed like mazes to maximize time you spend inside. The longer you spend in a store, the more impulse purchases you make. Research shows every additional minute in a store correlates with roughly $2 of additional spending. The produce section is usually at the front of stores, and essential items like milk and bread are placed in the very back. Stores want you to walk the entire building. The perimeter is where essentials live, but the supermarket wants you cutting through center aisles, where processed food and higher margin items sit. Center aisles are designed with turns and dead ends that force you past products you did not plan to buy. Every extra turn you make, you pass something that might become an impulse purchase. Stores also strategically place high-profit items at eye level and lower-profit items at top or bottom shelves. Cereals marketed to kids are positioned exactly at kid eye level. Expensive adult brands are at adult eye level. Cheap generic brands are down low, where you have to bend to see them. Stores make more profit when you grab what you see first. which is usually the priciest option at your natural line of sight. The checkout experience is also designed to extract money from you. Lines snake past impulse purchase items like candy, magazines, and snacks. You are standing there with nothing to do but look at products you did not plan to buy. Some stores use psychological scarcity by putting limited time signs or displaying how many units remain. This creates fake urgency. The entire store is basically a sophisticated system for separating you from as much money as possible. Understanding the design helps you spend less. The pink tax and why women pay more for the same products. The pink tax is not a government tax. It is the hidden markup women pay when they buy products packaged in pink or marketed to women. The same product, literally the same product, costs more when marketed as feminine. A razor marketed to women costs more than the exact same razor marketed to men. Women's deodorant costs more than men's deodorant, even when they have identical formulas. This is not a coincidence. It is systematic and adds up to thousands of dollars over a lifetime. Studies found that over a lifetime, the pink tax costs women substantially more than men for identical products. This includes everything from personal care to clothing to toys. A bicycle marketed to girls is more expensive than the same bicycle marketed to boys. A razor blade refill marketed to women is more expensive than the male version. Even though manufacturing cost is identical, gendered packaging and marketing command price premiums. Companies justify this by claiming different formulations, but often the only difference is packaging color. Why do companies do this? Because they can. Women are socialized to accept gendered products, and companies exploit that. If a woman walks into a store and sees pink razors marketed to her and blue razors marketed to men, she buys the pink ones because they are marketed to her, even though they cost more. Stores have done research showing that customers will pay more for gendered products. The pricing is higher not because products cost more to make, but because the market will bear higher prices for feminine branded goods. The pink tax extends beyond personal care into clothing and services. Women's clothing is often more expensive than men's clothing, even when fabric and manufacturing are identical. Haircuts for women are more expensive than haircuts for men at the same salon. Dry cleaning charges more for women's shirts than men's shirts. These price differences add up significantly over decades. Resisting this means buying gender-neutral products when possible, comparing unit prices across gendered versions, and pushing back when gendered pricing does not match any real difference in value. What happens if the US dollar loses its reserve status? The US dollar has been the world's reserve currency since 1944, meaning countries and companies hold dollars to conduct international trade and keep them as their primary backup funds. If the dollar lost this status, the changes would ripple through the global economy instantly and painfully. The first impact hits your wallet through inflation. When the dollar is the global reserve, other countries buy and hold massive amounts of it, keeping the currency strong without America needing to do much. If countries stopped holding dollars and flooded the markets selling their reserves, a sudden deluge of dollars would devalue the currency, making imports far more expensive. Your groceries, clothes, and electronics would all cost significantly more overnight. Interest rates would spike dramatically because foreign governments currently lend money to America at low rates based on trust in the dollar. If that trust evaporated, lenders would demand much higher rates to compensate for the increased risk. Banks would pass these costs directly to you through higher mortgage rates, car loans, and credit card fees. Businesses would borrow less, hire less, and slow growth substantially. The psychological shift might matter most of all because the dollar's reserve status rests entirely on belief. Once that belief cracks, it shatters quickly, and other countries rush to diversify into different currencies, creating a cascading effect. However, this scenario remains unlikely soon because no current alternative currency has the depth and stability needed to replace the dollar globally. The euro has political fragmentation issues. The Chinese yuan is not freely traded. Cryptocurrency is too volatile. The system has tremendous inertia despite its vulnerabilities, and replacing the dollar would require decades of institutional change that nobody has started yet. Why the stock market goes up while the economy feels down. Your stocks gained 30% last year, but your paycheck stayed the same and rent went up. This frustrating disconnect between the stock market and your daily life happens constantly and reveals something crucial about how wealth inequality actually works. The stock market measures corporate profits, not workers' salaries or living standards. Companies can make record profits while paying workers the same wages they paid 5 years ago. The profit gains go entirely to shareholders rather than employees. If a company cuts costs by freezing wages or reducing hiring, the stock price often rises because the company becomes more profitable. The economy might feel worse for workers, while stocks soar based on that exact same cutback. Technology creates another major disconnect because tech companies can grow profits without growing employment much. One engineer at an automation company might do work that replaced 10 factory workers. The automation company's stock rockets up while those 10 workers face unemployment or wage cuts. The aggregate economic picture looks weaker even as stock prices climb. Shareholders get richer while communities feel the downturn. Monetary policy drives stock prices even when the underlying economy stalls. When the Federal Reserve keeps interest rates very low, investors flood into stocks because bonds offer virtually nothing. Easy money policy inflates stock prices separate from business reality. Add in stock buybacks where companies spend their cash buying their own stock to push prices higher, and you get disconnected markets everywhere. The stock market is betting on future corporate earnings, while the economy measures what is happening to regular people right now. They are literally measuring different things, which is why celebrating stock market records while ignoring stagnant wages misses the point entirely. How a 0% interest rate changed the world. 0% interest rates sound great if you want to borrow money, but they fundamentally rewired the entire global economy and created massive problems nobody fully solved. When rates hit zero, savers lost their income source entirely. A retiree with $1 million used to collect $50,000 yearly in interest from bonds. At 0%, that income disappeared. Desperate for returns, retirees and pension funds poured money into stocks and real estate instead. This massive shift in capital allocation away from safe bonds pushed stock valuations and home prices to extreme levels that made assets unaffordable for young people who had not inherited wealth from previous generations. Borrowing became essentially free, which sounds wonderful until you realize the consequences. Companies borrowed unlimited money at 0% to buy back their own stock, rather than invest in factories or worker training. Real estate investors borrowed endlessly to buy every available home, converting properties from owner-occupied to rental investment. The 0% policy meant speculators could profit massively by simply borrowing cheaply and buying assets. Regular people saving for homes could not compete with institutional money that could borrow for free. The strangest effect was killing the concept of prudent saving. Before 0%, you could earn real returns by being cautious. After 0%, playing it safe meant losing money to inflation. The policy also created moral hazard on a massive scale. Banks knew the government would never let rates rise much because debt levels had become so extreme. Anyone with debt could gamble recklessly, knowing rates would stay low. That encouraged ridiculous risk-taking everywhere. People had to take bigger risks just to maintain their purchasing power, pushing retirees toward dangerous investments they did not understand. We are still dealing with the distortions and the investments that should have never been made. How a war in one country makes your bread more expensive. When Russia invaded Ukraine, grain prices exploded globally within weeks. The connection between distant warfare and your grocery bill reveals how fragile and interconnected the food system actually is. Ukraine produced huge quantities of wheat, barley, and sunflower oil. Russia also produced massive grain exports. Together, they supplied roughly 30% of the world's wheat exports, and even more of global sunflower oil. When the war shut down ports and made farming impossible in those regions, global supplies dropped instantly. With supply down, but demand unchanged, prices skyrocketed. That price increase made your bread cost more at the store and meant poorer countries that imported wheat suddenly could not afford to feed their populations. The commodity market amplified the problem significantly. Traders betting on future grain prices panicked and sold everything. Governments started hoarding their own grain to guarantee domestic food security. Each country's selfish behavior meant less grain on the global market for everyone else. Prices went even higher than the physical shortage required. A war thousands of miles away created global food insecurity, partially through actual scarcity and partially through panic. Fertilizer prices also exploded because Russia and Belarus produced about 40% of global fertilizer exports. Farmers could not afford to properly fertilize fields, which meant lower crop yields everywhere else. This teaches a crucial lesson about supply chains. We built incredibly efficient systems where each region specializes in what it does best. Ukraine farms grain because the soil is perfect. But efficiency means no redundancy. When one source disappears, nothing replaces it. Adding buffer stocks or backup suppliers costs money. In peaceful times, that seems wasteful. But one war shows how fragile the system really is. We made the world efficient, but not resilient, and that vulnerability has serious costs for everyone. The dark side of buy now, pay later. Buy now, pay later sounds like a responsible way to afford things without credit cards, where you get the item immediately and make 4 equal payments. In reality, it is a predatory trap that exploits psychology in ways traditional credit cards never could. The psychological trick is the payment structure. Seeing 4 payments of $25 feels manageable, while seeing $100 up front feels expensive. Your brain accepts installments even when you would reject the lump sum. You end up buying stuff you would not actually purchase if you had to pay cash today. The spending happens instantly, but the pain spreads across weeks. By the time you make the final payment, you have already forgotten you were buying something above your means. Buy now, pay later. Companies make their money from merchant fees, not from you paying interest. The merchant pays up to 8% of the sale price to these companies. To hit profitability, they need you making impulse purchases constantly. The psychological trap is the entire business model. You feel like you got a responsible credit option, when really you got a system engineered to maximize impulse spending. Traditional credit cards charge you personally if you miss payments, so you stay vigilant. Buy now, pay later spreads payments so thin that people lose track of how many active payments they have running simultaneously. Missing a payment triggers aggressive debt collection with fees that spiral fast. One missed payment can balloon into hundreds of dollars in charges. Young people using these services often have thin margins financially. One late payment means missed rent or food. The worst part is the data harvesting. Every impulse purchase gets recorded and analysed. These companies know your shopping patterns better than you do. They use this information to engineer the system to maximize their take. You think you are making free decisions, when actually you are being guided by behavioral economics designed to extract money you do not have. Why the retirement age is actually a math problem. We debate the retirement age like it is a moral question about how long people should work, but actually it is pure mathematics. The math says the retirement age should be rising, and it will keep rising unless something changes dramatically. When Social Security started, life expectancy was around 60 years old. The program set retirement at 65. Most people would work their whole lives and maybe collect benefits for a few years. Today, life expectancy is around 79 years. If you retire at 65, you might collect benefits for 14 years. That is an extra decade of payments compared to the original design. Meanwhile, birth rates have collapsed. When Social Security started, 5 workers contributed for every retired person. Today, that ratio is around 3 to 1 and falling. Fewer young people need to pay for more years of old people's benefits. Either benefits shrink, taxes rise massively, or people work longer. Nothing else works mathematically. The politicians pretending we can keep everything the same are lying with numbers. There is no magical solution. Some combination absolutely must happen. If we raise the retirement age to 70, people would work 5 more years and collect benefits for 9 years instead of 14. That dramatically improves the math. If we cut benefits, less money goes to retirees. If we raise taxes, more money funds the system. Working longer actually makes sense health-wise too. Manual labour jobs were the norm when retirement age was set at 65. Today, most jobs are not physically brutal. People are living longer and healthier. The math forces the conversation, but the moral question of how we want to live our later years matters too. We cannot avoid the math problem by debating values. The values matter, but they operate within mathematical constraints we must acknowledge honestly. How bailouts actually work and who pays for them. When a bank collapses, the government swoops in to bail it out. Politicians say this saves the economy, but bailouts are actually a transfer of money from ordinary people to wealthy investors who made bad bets. A typical bailout works like this. A bank makes reckless loans, and those loans go bad. The bank's assets are now worth less than deposits it owes people. Without help, the bank fails, and depositors lose money. The government steps in and either injects cash or buys bad assets at inflated prices. Taxpayers cover the losses while wealthy investors and executives who took the risks face no consequences. They keep their wealth while everyone else absorbs the losses. The moral hazard is enormous. When you know the government will bail you out if things go wrong, you take bigger risks. Bankers reason that if it works out they get rich, and if it blows up the government covers the losses. This is the opposite incentive structure from regular people. You work carefully because if you fail, you go bankrupt. Bankers can gamble freely because their downside is protected by taxpayers. Bailouts concentrate wealth upward. During the banking crisis, executives made billions through reckless behavior and kept those billions after taxpayer-funded bailouts. If the government let the bank fail, some investors would lose everything, but the economy would correct. Resources would shift to better-run institutions. The correction would hurt, but it would be real. Bailouts prevent the correction and entrench the bad actors instead. The strange thing is, bailouts are often framed as the only option. Politicians say, if we do not bail out the bank, the entire economy collapses. We could let banks fail, but protect depositors separately. Regular savers would be protected, and investors betting on the bank would lose. This splits the problem correctly by protecting people who need protection while letting investors take their lumps. Instead, we bail out everything because institutions convince politicians that collapse lurks around every corner. Why gross domestic product is a terrible way to measure happiness. A country could have record gross domestic product while most people feel miserable. This happens constantly and shows why using gross domestic product as the main measure of success is fundamentally broken. Gross domestic product counts total money spent on everything in a country, but does not care if that spending makes people happy. Imagine a hurricane destroys your house and your neighbor's house. You both rebuild and spend $200,000 each. Gross domestic product goes up, even though you are now homeless, living in a rental apartment while rebuilding. Gross domestic product is blind to what the money actually creates or destroys in human terms. Pollution is another killer problem. A factory produces widgets counted in gross domestic product while polluting the air and poisoning water. Cleaning up that pollution gets counted again as another addition. You get counted twice for the same resource destruction, while you cannot measure health damage to people breathing toxic air. Gross domestic product says the factory created value when it actually destroyed it. Inequality gets erased from gross domestic product entirely. A country where wealth is distributed evenly might have the same gross domestic product as a country where one person has everything and everyone else has nothing. The number looks the same, but lived experience is completely different. Leisure time, community, family, and health do not appear in gross domestic product. A society that works half as much but spends time with family might have lower gross domestic product, but dramatically higher happiness. We should measure what actually makes life good rather than counting money flowing around. Gross domestic product is not inherently bad data, but using it as the main success metric makes you optimize for the wrong thing. We need better measures, including quality of life metrics that matter more than raw spending numbers ever could. The difference between rich and wealthy. Rich people have high income while wealthy people own assets. The difference matters enormously, but we use these words interchangeably, and that causes serious confusion about money. A surgeon earning $500,000 per year is rich with massive income. But if the surgeon spends it all on a big house, fancy cars, and expensive vacations, the surgeon owns almost nothing. The surgeon is completely dependent on continuing to work. If the surgeon gets injured and cannot work, the income disappears instantly. The fancy house and cars still have mortgages and loans attached. When income stops, debt collection begins. Rich without wealth is incredibly fragile. A person who inherited a portfolio of dividend stocks worth $5 million is wealthy. The stocks produce $150,000 yearly in income without the person working. The person can live comfortably indefinitely, even if unable to earn income. The portfolio provides options and security that rich people lack. If this person wants to take 6 months off or change careers, they can because they own assets that generate income. Wealthy without high income is very secure. The wealthy person has enormous advantages because their assets compound. The stock portfolio grows and generates more dividends over time. The wealthy person can take calculated risks because they have a financial cushion. They can start a business knowing they will not starve if it fails. They can wait out market downturns without panic selling and can negotiate better salaries because they do not desperately need the job. The truly powerful position is being both rich and wealthy. You earn large income and also own assets that generate income. This combination is how generational wealth builds. Understanding the distinction explains why income inequality is real, but wealth inequality is more important. Income you earn eventually stops. Wealth you own keeps flowing forever if you protect it carefully. Why your house is an expense, not an investment. Most people believe buying a home is the smartest financial move they'll ever make. You hear it everywhere. Your parents said it. Your real estate agent definitely said it. But here's the uncomfortable truth that nobody wants to admit. Your primary residence is primarily an expense, not an investment. This doesn't mean home ownership is bad. It means we need to be honest about what it actually is. The difference comes down to cash flow. When you own a rental property, tenants pay you money every month. That's income. That's what makes something an investment. With your own home, you pay money every single month. You pay the mortgage, you pay property taxes, you pay insurance, you pay for maintenance and repairs and upgrades. You're not receiving money, you're spending it. That's the definition of an expense. People confuse appreciation with investment returns. Your house goes up in value and everyone celebrates. But appreciation is only theoretical wealth until you sell. Meanwhile, you're bleeding money into that property every month for 30 years. You're also paying closing costs and realtor fees when you eventually sell. These transaction costs eat away whatever gains you made. Now add up all the money that leaves your pocket. The mortgage interest is not going toward equity for the first decade. You've paid hundreds of thousands in interest while the bank owns your house. You cannot take that money out without borrowing against the equity. You cannot redirect it to investments that might actually outpace inflation. Your house is a consumption choice, not an investment choice. And that's completely okay. Just stop pretending it's something it's not. How tax loopholes are perfectly legal. The word loophole makes it sound like tax avoidance is a sneaky hack that barely exists in the legal grey area. That's exactly the marketing. Tax avoidance is completely legal and it's built right into the tax code. Powerful people don't break tax law. They just use the law differently than everyone else. Here's what people get wrong. There's no secret underground network of accountants using forbidden techniques. These strategies are published in plain English. You can look them up. The difference is that using them requires money up front and professional expertise. A person making $60,000 a year cannot benefit from most tax strategies. A corporation making $600 million absolutely can. Let's use an example. Someone who donates appreciated stock to charity avoids capital gains taxes on that stock. This is legal. Someone who donates cryptocurrency gets the same benefit. Legal. Someone who uses tax loss harvesting to offset investment gains is doing what the government literally designed the system to allow, not a loophole, a feature. The real situation is this. Everyone is allowed to structure their finances to minimize taxes. But the ways to do that are expensive to set up. You need lawyers. You need accountants. You need existing capital to work with. A wealthy person pays $50,000 in fees to save $500,000 in taxes. That math makes sense to them. Regular people just pay what the government requests. We call the wealthy person smart. We call the regular person unlucky. They're both following the exact same tax code. Why the 40-hour work week was invented. The 40-hour work week is not some sacred law of physics. It's not a biological requirement for human productivity. It was an invention, a specific choice made by specific people at a specific time to serve specific interests. Understanding why helps you see modern work culture differently. Before industrialization, people didn't clock in and out. Farmers worked intense seasons and rested other seasons. Craftspeople worked on projects. The concept of measuring work in hours per week is purely modern. Then factories arrived. Factory owners needed to coordinate hundreds of workers on assembly lines. They couldn't have people wandering in whenever they felt productive. The factory demanded synchronization. The 40-hour week specifically came from labor movements in the 1900s. Workers were dying. They worked 70 or 80 hours and their bodies just broke down. Labor activists fought for reduced hours and won. 40 hours seemed like a reasonable compromise. It was progress. But here's the thing about industrial-era compromises. They were optimized for factory efficiency in 1930, not for knowledge work in 2026. Knowledge work is completely different from factory work. A programmer hitting a creative flow state might produce 4 days of solid work in 6 hours. Then they might stare at their code for 2 hours and accomplish nothing. A designer might solve a problem in their sleep and produce the solution in 20 minutes. Requiring 40 hours of presence time doesn't create 40 hours of valuable output. But we inherited the factory schedule anyway because institutions change slowly. The invention just stuck around. How billionaires pay 0% in income tax. Billionaires absolutely can and do pay 0% income tax in certain years. This happens without breaking any laws. This happens without sneaky tricks. This happens because of how income and wealth are legally defined. Once you understand this distinction, the whole system makes sense. The key word is income. Income and wealth are not the same thing. Income is money you earn or receive. Wages are income. Dividends are income. Interest is income. Wealth is the net value of everything you own. If a billionaire does not sell their assets, they have not received income. No income means no income tax owed. That's not a loophole. That's the definition. Here's a real scenario. Someone owns a company worth $5 billion. In year 1, the company doesn't pay dividends. The owner receives $0. They owe 0 income tax. But their wealth increased because their company's value increased. That increase only becomes taxable income if they sell shares or take money out. Some billionaires borrow money instead. They borrow against their assets, get cash without triggering income tax, spend the money, and when the loan comes due, they sell some assets to repay it. The system is designed around a particular view of fairness. Income taxes are supposed to tax what you earn. Wealth taxes are a completely different thing. Most countries don't have wealth taxes. The United States doesn't have one either. So an individual can accumulate billions in assets and owe 0% in income tax every single year. It's legal. It's intentional. Whether it's fair is a political question, not a tax question. The hidden cost of passive income. Passive income sounds like magic. You do work once and money flows to you forever. You record a course and people buy it for years. You write a book and collect royalties. You build an app and it generates revenue while you sleep. The dream is compelling. The reality is that passive income has massive hidden costs that nobody discusses up front. First is the opportunity cost of initial production. Creating that course takes 100 hours of your time. That's 100 hours you're not spending on things that generate immediate money. For someone making $50 per hour, that's $5,000 of opportunity cost. The course needs to generate at least that much before you break even. Many courses never do. You lost the money you could have made working a job. Second is the ongoing maintenance. That course goes out of date. Technology changes. Competitors launch better courses. You need to re-record sections and update material. You're still working. The passive part slowly disappears as you patch and maintain your old product to keep people buying it. Some creators spend more time maintaining old products than launching new ones. Third is the brutal discoverability problem. Your passive income product competes against millions of others in the same category. You need marketing. Marketing means spending money or spending time. Either way, it's not passive. The truly passive part only happens if you've already built an audience through years of active work. If you're starting from zero, expect 5 to 7 years of heavy lifting before anything resembling passive income actually shows up. Why high-yield savings accounts are barely keeping you even. High-yield savings accounts are being marketed as a smart financial move. The banks show you rates that sound impressive. 5%, 5.35%. Some accounts are offering 5.5%. Everyone's suddenly convinced they've found free money. But the math is more complicated than the ads suggest. First, understand inflation. When prices across the economy rise, your money buys less stuff. Real inflation is currently running somewhere between 3 and 4%, depending on how you measure it. If your savings account earns 5%, but inflation is 4%, your actual return is about 1%. You're not getting rich, you're barely staying even. The purchasing power of your money is creeping forward at a crawl. Second, consider taxes. That 5.35% interest is taxed as ordinary income. If you're in a 24% tax bracket, you're paying a quarter of that interest in taxes. 5.35% becomes about 4% after taxes. Now with 4% inflation, you're losing money in real terms. You're paying the government to store your cash while prices rise around you. Third, rates change constantly. Banks are currently offering these rates because the Federal Reserve policy made them necessary for a short window. Those rates will not stay at 5% forever. When the Federal Reserve changes its policy, these rates will drop back down to near zero. Your high-yield savings account will return to being the place you park money for safety, not for returns. It's a temporary phenomenon being marketed as a permanent solution. How lifestyle creep kills your net worth. Lifestyle creep is what happens when your spending automatically rises to match your income. You get a promotion. You start earning an extra $1,000 per month. Within 6 months, you're not noticing that extra $1,000 anymore because you've started spending it on things that feel normal now. Your net worth doesn't increase even though your income did. This happens so gradually you don't even notice it. You upgraded to a nicer apartment. Then you started getting lunch out more often instead of bringing it from home. Then you bought better clothes for your upgraded job. Then you got a better car because all your co-workers have nice cars. None of these decisions felt unreasonable at the time. Each choice seemed affordable, but collectively, they consumed your entire raise. You're still living paycheck to paycheck despite making more money. The insidious part is that your baseline expectation shifts. You forget what life was like with less. Going back to the cheaper apartment now feels like deprivation, even though you once lived that way happily. The cheaper car feels insufficient, even though it worked perfectly before. You've ratcheted up your lifestyle, and you can't ratchet it back down without feeling deprived. You're now locked into higher spending forever. Breaking this requires intentional decisions. When you get a raise, you have to actively choose to keep your lifestyle the same and invest the difference. That's not normal human behavior. Normal behavior is to let lifestyle creep happen automatically. But if you want to build wealth, you have to be the exception. You have to receive more money and deliberately not spend it. You have to feel the discomfort of not upgrading your life even though you could. Why you should not keep all your money in a bank. Most people keep their money in a bank account because banks are safe and insured. The Federal Deposit Insurance Corporation guarantees deposits up to $250,000. Banks are regulated. Governments oversee them. This all feels very secure. And then inflation happens, and your money loses real value sitting in an account, earning near 0%. The real question is not whether the bank is safe. The real question is whether keeping 100% of your savings in a bank account is the best use of your money. It's not about safety, it's about opportunity. Bank accounts protect your money from loss. They do nothing to protect your money from inflation. Your savings account is slowly being eaten by rising prices, even if nothing bad ever happens. A balanced approach keeps enough in a bank for emergencies and expenses. Most financial advisors suggest 3 to 6 months of expenses. Keep that in a bank where you can access it immediately. But money beyond that emergency fund should be in places that actually earn returns. Stock index funds have historically kept pace with inflation. Real estate has historically kept pace with inflation. Bonds have historically kept pace with inflation. Bank accounts have not. The risk is that stocks go down sometimes. Real estate requires capital up front and has transaction costs. Bonds pay low interest rates in some environments. But these risks are different from bank safety. These are opportunity risks. You might miss out on gains. That's different from losing your money. And honestly, by keeping everything in a bank earning 0.01%, you're taking the greatest risk of all. The absolute certainty that inflation is reducing your purchasing power every single year. The golden handcuffs of high-paying jobs. High-paying jobs are golden handcuffs. You get paid enough that staying feels rational. You get paid enough that leaving feels like financial suicide. The salary increases your lifestyle immediately, and now you're trapped in a cycle where you cannot afford to leave, cannot afford to negotiate, and cannot afford to change careers. Here's how it works. You get hired at $120,000 per year. That's more money than you've ever seen. You buy a nice apartment. Now rent is $4,000 per month. You get a new car because you can afford the payment. That's $600 per month. You get nicer furniture and better restaurants and clothes that match your income level. Within 2 years, you're spending $110,000 annually. Now you're making $120,000 but spending $110,000. You have only $10,000 cushion. If you want to change jobs and take a pay cut to 50%, your expenses mean you cannot afford it. You'd go into debt. So you keep the job you might hate because financially you cannot leave. The salary wasn't a gift. It was a trap. You traded freedom for income, and now you own nothing. Meanwhile, someone who made $60,000 and kept their lifestyle at $50,000 can afford to take risks. They can change jobs. They can negotiate harder because they don't desperately need to keep this job. They can quit and take a sabbatical. They have flexibility. The person making twice as much has less flexibility because they've consumed their entire income. Money spent on lifestyle is money you can never get back. What is a central bank digital currency? A central bank digital currency is digital money created and controlled by the government. No bank, no private company, just the government issuing a digital version of currency that sits in an account you control through an app. The technical side is straightforward. The implications are more complicated. Right now, when you have money in a bank account, the bank holds it for you. The bank is the intermediary between you and the Federal Reserve. If the bank fails, the Federal Deposit Insurance Corporation covers your money. But the bank has some independence. A central bank digital currency would cut out that middle person. You'd have an account directly with the Federal Reserve. The government would see every transaction. The government would control access. The government could theoretically freeze your account if they decided you violated some rule. Supporters say this is more efficient and more secure. You don't need banks taking fees. Money moves faster. It's harder to counterfeit digital currency. They say privacy concerns are overblown because governments already track financial transactions through banks. Why does it matter if they track it directly versus through an intermediary? Opponents say the intermediary matters more than supporters acknowledge. Banks have competitive interests. If your bank is terrible, you can switch to another bank. The government is a monopoly. You cannot switch governments if you don't like how they run their currency. Opponents also note that direct government control over every financial transaction is unprecedented and concerning. It's not about surveillance. It's about whether any single entity should have that much control. Why physical cash is disappearing. The way we pay for things has changed dramatically over the past decade. Your grandparents carried wallets stuffed with bills. Today you probably go weeks without touching actual paper money. Digital payments are faster, safer, and way more convenient than fumbling through a cash drawer. Every time you tap your phone or swipe a card, you are voting with your wallet for a cashless future. But here is the thing that nobody talks about. Cash gives you anonymity and freedom. When you hand someone $5, there is no record. No company knows what you bought. No algorithm tracks your coffee habit. Digital payments create a permanent trail of your spending, your location, and your preferences. Banks love this. Governments love this. Your data becomes incredibly valuable to people who want to know everything about you. The disappearance of cash also makes you more dependent on the financial system itself. If your bank account gets frozen, you cannot withdraw cash. If there is a power outage or a technology failure, you cannot pay for anything. During a financial crisis or a natural disaster, digital systems fail. Cash still works. This is not being paranoid. This is recognizing that systems fail, and having a backup plan makes sense. So why is cash really disappearing? Convenience sells. Profit margins are better for banks when everything goes digital. Transaction fees add up for everyone except the banks. The shift away from cash is not some accidental byproduct of progress. It is a deliberate choice by companies and governments who benefit from tracking your money. Understanding this shift means understanding who has power over your financial life. The economics of the creator economy. Making money online has fundamentally changed what it means to have a career. 10 years ago, being a YouTuber or a streamer sounded like fantasy. Today, millions of people earn real money creating content. They do not work for a boss. They do not have scheduled hours. They answer directly to their audience, and their audience determines their income. The creator economy is built on attention. You create content. People watch it. The platforms that host your content monetize the attention through ads, sponsorships, and premium subscriptions. You get a cut, though rarely the biggest cut. YouTube takes 30% of ad revenue. TikTok keeps even more. Your followers generate millions of dollars in value, yet you see only a fraction. This is called the attention tax, and it is how platforms become billionaire factories. The challenge is that creator income is wildly unstable. One viral video can change your life. One algorithm change can destroy it. You could spend months building an audience only to watch engagement collapse overnight. When the platform changes how it recommends content, you have no safety net, no severance package, no retirement plan. You are an independent contractor to the algorithm, and contracts can be terminated without warning. Yet millions choose this path anyway, because the alternative feels worse. Traditional employment feels suffocating to many people. The creator economy promises freedom and unlimited upside. The reality is messier. Success requires being part business person, part entertainer, and entirely at the mercy of platforms that do not owe you anything. It is genuinely better for some. For others, it is a financial roller coaster they cannot afford. How artificial intelligence will change the value of your degree. Your college degree was supposed to be your ticket to a good job. For decades, this was basically true. You went to college, you got a degree, employers hired you because you had that degree. It was a straightforward economic transaction. That certainty is vanishing. Artificial intelligence is becoming genuinely capable at tasks that required expertise and education. It can write code. It can design graphics. It can analyze data. It can write legal documents. It can conduct research. None of these require a human with a 4-year degree anymore. The degree still signals something, though. It signals that you can follow instructions, complete long projects, and show up consistently. But artificial intelligence is getting better at all of these things faster than education systems are changing. This does not mean college is worthless. It means the value proposition is shifting. A degree in something the artificial intelligence cannot do yet is valuable. A degree in something it can already do better is increasingly risky. Fields like engineering, medicine, and specialized research are still valuable because they combine artificial intelligence with judgment, ethics, and human responsibility. Generic business degrees and general knowledge degrees are becoming less valuable by the month. What matters now is adaptability and specialization. The people who will thrive are those who understand both artificial intelligence and their specific field. They use artificial intelligence as a tool instead of competing against it. They pivot when their skills become obsolete. They keep learning instead of assuming a degree is a terminal achievement. The old deal where you learned everything in college and then applied it for 40 years is dead. The new deal requires lifelong learning and the ability to reinvent yourself as technology changes. Can we ever actually pay off the global debt? Governments around the world owe more money than ever before. The United States federal debt is over $30 trillion. Japan owes even more relative to its size. Every developed nation has borrowed vast sums. The question people always ask is simple: will we ever pay this off? The answer reveals something fundamental about how modern economies work. Most national debt never actually gets paid off. Instead, governments refinance it endlessly. They take out new loans to pay off old loans, rolling the debt forward year after year. This works fine as long as the economy keeps growing and investors keep believing the government can pay its bills. Japan has done this for decades. So has the United States. So has most of Europe. But here is where it gets interesting. Governments have a tool that regular people and businesses do not have. They can create currency to pay their debts. This sounds like a magical solution until you realize the consequence is inflation. Every dollar you have becomes worth less. Your savings shrink in real terms. This is why inflation is sometimes called the hidden tax. It is how governments reduce the real burden of debt without technically defaulting. The realistic answer is that global debt will never be fully repaid, and it does not need to be. It gets managed, refinanced, and slowly eroded through inflation and economic growth. Countries that cannot access easy borrowing or that lose investor confidence face real problems. But developed nations with stable institutions can carry enormous debt loads indefinitely. The trick is not paying it off. The trick is making sure your economy grows faster than your debt does, so the burden gradually becomes smaller. That is the game being played.